What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, let's jump in. Okay, happy Monday everybody, wishing you all a productive week ahead. Today, Monday, the Transportation Ministry in Beijing published data which showed, among other things, that investment in road and waterway infrastructure within the mainland in the first 2 months of this year was up almost 15% year on year. Though concerning, it shouldn't be too surprising. We know from December and January, of course, the government called on local authorities to front-load infrastructure spending to cushion the slowdown from the housing crisis and other economic headwinds. We also know that increased infrastructure spending is a core part of Beijing's playbook when it comes to dealing with slowdown. Of course, what is concerning, like we have discussed many times in the past, is that while infrastructure spending was very much needed 2 decades ago, and as such resulted in massive productivity gains for the economy for at least 10 years now and likely longer, the productivity gains from the spending has declined dramatically. At the same time, debt servicing capacity, measured crudely by the debt-to-GDP ratio, has worsened at an alarming rate, with both local government and household debt jumping in recent years. Looking at the transportation data, it becomes clear that debt-fueled infrastructure is being used as a growth tool. Some of the largest increases in infrastructure spending are in the poorest regions. For example, in the poor southeastern province of Guizhou, investment in road and waterway infrastructure almost doubled versus 15% nationwide. Peking University China finance expert Michael Pettis observed on the data today, quote, "When China needs more growth, it expands infrastructure. The consequent growth is then used to justify the expansion. This is what I mean in earlier comments about the intense pro-cyclicality of infrastructure spending in China." End quote. Interestingly, the northern municipality of Tianjin, a city about an hour's high-speed rail, even less actually, from Beijing, the capital, nearing the coast and often seen as a gateway from the ocean to the capital, and frankly a very debt-bloated city, saw the sharpest decline in road and waterway infrastructure investment during the first 2 months of this year, with the investment plunging 76.2% year on year. Though this shouldn't be too surprising considering it has been forced in recent years to deleverage after a massive debt-fueled infrastructure spurge for well over a decade led to it becoming so over-leveraged that the central government had to step in. However, despite this, a reduction of over 76% is quite notable. Okay, next up, the Hong Kong Special Administrative Region. If you're enjoying the content, guys, don't forget to hit the like button. It's a huge help, as always. Thank you so very much. And if you're watching for the first time and you're getting some value from the episode, if you enjoy the content, we release one of these every day. Maybe consider subscribing, and you'll have the most up-to-date analysis when I release them. This morning, Monday morning, Hong Kong leader Chief Executive Carrie Lam announced a set of changes to previously strict COVID control measures which will come into effect on the first day of next month. This coming after several weeks of the densely populated Special Administrative Region wrestling with an explosion of cases, including a higher than usual number of deaths. There looks to be light at the end of the tunnel though, with Lam expressing, quote, "Many experts regard the peak of the current wave as over. Hong Kong's epidemic development has gone on a downward trend." End quote. Now let's quickly touch on the changes for our information. The opening up, it may be of use to those based in Hong Kong or those who are thinking of traveling to Hong Kong or have business that's Hong Kong related. First, the current 14-day requirement for most travelers will be lowered to 7 days on condition that guests in hotel quarantine return negative rapid test results on the 6th and 7th days of their stay. 2. A ban on flights from 9 countries: Australia, Canada, India, Nepal, France, the Philippines, Pakistan, Britain, and the United States will be removed. 3. The city's planned mass testing drive will be suspended. This is still very much up in the air. And 4th, social distancing measures will be relaxed over 3 phases starting from later in April. In the first phase, gyms, game centers, salons, massage parlors, and places of worship, as well as sports venues, will be allowed to reopen. The operating hours will be limited, however, and groups will be limited to 4 people. In the second phase, other businesses from bars to karaoke clubs to general clubs will reopen. And then in the third phase, all restrictions on venues and operating hours will be lifted. Okay, next up, Chinese financial economic developments, carbon, and the geopolitics of global commodities trading. The US accounting watchdog, which oversees the audits of public companies, confirmed that it has been working with Chinese authorities to reach an agreement over a long-standing dispute that has hindered its access to the audit work papers of US-traded Chinese businesses. Quote, "The simmering dispute has made it possible for Chinese companies to get booted from US exchanges for failing to meet audit requirements. The first batch of companies in violation of US law were identified by the Securities and Exchange Commission, SEC, last week. That news contributed to one of the steepest sell-offs of US-traded Chinese stocks since the global financial crisis, a pummeling that spread to Chinese tech shares traded in Hong Kong." End quote. We did a deep dive into the sell-off and what it means for the market and the economy last Tuesday and the following day last Wednesday. Also this week, bad news for those concerned about carbon emissions. According to the National Energy Agency in Beijing and the National Bureau of Statistics, also in Beijing, in the first 2 months of this year, China's coal output jumped 10.3% from the previous year, reaching 690 million tons. Analysts with Yicai explained that the increase came after state-owned coal miners were urged to ramp up production for winter heating, as well as a coal export ban by Indonesia. Like we said when we covered that ban at the time, Indonesia is China's largest overseas supplier. The data also showed that the country's electricity consumption during the same period grew 5.8% year-on-year, driven by February's quite high 16.9% increase year-on-year. On this topic, the Ministry of Ecology and Environment also recently published findings from an inspection last year, finding that, surprise, surprise, several major firms have falsified carbon emission reports. Several large, high-profile domestic firms were charged with tampering with test results and falsifying inspection records. And in what could end up being a good development for Australia, or at the very least Australian iron ore traders, late last week, the development of the world's largest known untapped iron ore reserve in West Africa was halted yet again by the government. This is a massive iron ore reserve in Guinea. Local government representatives expressed that there had been no progress with getting foreign investors, which are mostly Chinese, for this project to work towards the country's interest. This is what the local government officials said. It is being reported that the government has made several demands of the investors, including the construction of a railway. Now, this throws a spanner in the works of China's plan to use the mine project to reduce Chinese reliance on Australian iron ore amid geopolitical tensions with Canberra, a US ally in the Asia Pacific. Now, on this point, or rather on the other side of the coin, last week Australian Prime Minister Scott Morrison announced funding for rare earths refining, including vital components for high-tech batteries, as Australia works with the United States to diversify sources of the important materials away from China.
Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.